I mean, PPF which gives you 8.1% return. So the lowest pyramid. The lowest pyramid is a banking savings investments. The risk will be less, the return also will be less. Then move up with higher level. So you have bonds, corporate bonds and government bonds. Corporate bonds or government bonds. So government bonds, we call them as what? Gilt-edged securities. Gilt-edged securities. Okay? And when you go to the corporate bonds, the risk level is higher. The return is always higher. So you cannot, the corporate bonds cannot give you 7.1%. Corporate bonds may give you 9.2% or 10.5%. The risk is higher, the return is also higher. The next level, mutual funds. Relatively, the return is higher, the risk is higher. Then you go to the stocks, okay, equity stocks. Then you have the derivatives and futures contracts and the international stocks. Okay. So this is what the risk pyramid goes. Starting from lowest level, the x-axis the risk, y-axis the return. The higher the risk, the return is also what? Higher. So starting from cash equivalents, that is equivalent to savings account, okay, bonds, international bonds, real estate, stocks and international stocks. So when you go and buy international stocks, the risk is always higher, and the return is also always higher. Okay. That's what the relationship between risk and return. So higher the return, higher will be the risk. Okay. So we have three different type of risk. One is risk aggressive. Okay. You take up high risk. That means when you are young, you can take up higher risk. So you can start investing in stocks, higher risk. So it's called risk aggressive. Then you have risk moderate, risk conservative, moderate risk. So people invest in bonds and savings deposits, risk moderate, and risk conservative, and then risk aggressive. Risk aggressive and risk conservative. Okay. So risk moderate means you combine both bonds and stocks. So you have a short term. Short term means what? 1 month to 3 years. Your investment horizon. The investment horizon is 1 month to 3 years. You have to invest in savings account or fixed deposits account. And the investment horizon is say 3 to 10 years. We can start investing in bonds. The investment horizon is beyond 10 years. We can start investing in stocks. Okay. So this is what I just want to begin with. Then we move ahead with the risk calculation. So what is risk? So what is it? So we have seen the relationship between risk and return. So what is called risk? Risk is what? The likelihood of receiving return. Okay? The higher the likelihood, higher the possibility of likelihood, what I meant is possibility. So higher the possibility of receiving return, lower the risk. Lower the risk. Okay? So lower the possibility of receiving return, higher the risk. So higher the likelihood of receiving return, lower the risk. Lower the likelihood of receiving return, that means what? Higher risk. So when we invest in a post office, in banks, there is a higher likelihood, higher possibility of receiving return, the risk is less. Okay? When we invest in bonds, the likelihood is relatively less, the risk is start increasing. Okay? So when we invest in stocks, it's highly, the likelihood is very, very less because the stocks cannot, I mean, on the part of a company is not, it's not mandatory on the part of a company to declare dividend, unlike interest. So higher the possibility of receiving return is less, very, very less. So when the possibility of receiving return is very, very less, the risk level is very high. Okay? So what is risk? Risk refers to the possibility or likelihood of receiving the return. Is that clear? Risk part of it. There are two types of risk. There are two types of risk. One is systematic risk, another one is unsystematic risk. There are two types of risk. One is systematic risk, another one is unsystematic risk. So what is systematic risk? whenever you read the mutual fund documents, when you see the newspaper, any advertisement, what is the clause that comes? Whenever you read mutual fund investments, the advertisement comes. What is that? Mutual funds investments are subject to market risk. So what is that risk they refer to? What is the risk they refer to? Systematic risk. So the moment we start any business, business are subject to an inherent risk. So that inherent means what? By default it is there. The moment you start, by default that risk is there. That's what we call it as a default risk, inherent risk, market risk, all one and the same. The moment we start any business activity, so that risk no business can control over it. That particular risk no business can control over it. So they are known as uncontrollable risk. Okay? So whether you are a multi-billion-dollar company or 5 crore company or 50,000 turnover company. 50,000 turnover company. Okay? In a month you get 50,000 turnover. Very small petty shop that you have. Okay? 5 crore, 10 crore, small and medium enterprise. Okay? So you are $5 billion company. Whether you are 50,000 crore, 50,000 or 10 crore or $5 billion company, any type of company this risk is subject to. All these companies are subject to these risks. That we call it as what? Market risk or systematic risk or default risk or inherent risk or uncontrollable risk or non-diversifiable risk. I can keep on going like this. So how many words I said? Non-diversifiable, uncontrollable, inherent, default, market. All these are all meaning one and the same. So management is what? What is called management? Using different jargons. Generally you are a management student. Management student means what? Using jargons. Different jargons you have to use so that people should not understand what you are talking about. People should not understand. Generally people should come to you for consulting. So if everybody understands what you are talking, then there is no point in consultancy. Consultancy comes only when people talk, this very genius, this talking so many terms, that is, people come here for consulting. Okay? But when I am speaking to my management students, I need to be what? Very simple. But when you talk outside, okay, for a media, then you will have to speak all this. Meaning one and the same. Okay? So any business activity in the world, I am talking about 3 different levels of company. 50,000 turnover, 50 crore turnover, $5 billion turnover. All these companies subject to these risks. These risks is called what? Systematic risk or non-diversified risk or uncontrollable risk. Market risk. That's what that particular word comes. A statutory warning comes in a mutual fund document. Why? As we have a statutory warning when we buy a cigarette packet. Smoking is injurious to health. The same statutory warning bell is coming. That means what? You are investing, we are not guaranteed about your principal amount. You know that the risk is there, you are investing. You are informing whom? You are informing the investors. You are informing the investors, your money is not guaranteed. We are not responsible for your money. Okay? So you are saying indirectly. There are 3 types of risk. There are 3 types of this unique risk. Another word I can say, unique risk. Unique risk. Okay? So there are 3 types of risk. One is interest rate risk. 3 types of systematic risk. The total risk is equivalent to what? Total risk. Total risk is equal to what? Systematic risk. And what? Total risk. Total risk is equal to what? Systematic risk and unsystematic risk. Systematic risk and unsystematic risk. Okay. What are the different meanings for systematic risk? What are different meanings for systematic risk? Different term. Market risk, uncontrollable risk, inherent risk, non-diversifiable risk, default risk, unique risk, okay, plus unsystematic risk. This risk is subject to what? This risk is subject to any company. Any company, this particular risk is there. Okay? There are three types of systematic risk. There are three types of systematic risk. One is interest rate risk. Interest rate risk. Okay? What is that? Changes in interest rate. Who is changing interest rate in our country? RBI. We don't have any control over this RBI. No? So RBI is changing interest rate. Now what is interest rate is today is low or high? Today the interest rate is low or interest rate is high? Low. Low. Interest rate is low. Very low interest rate. You go to any bank, the banking loan is very low interest rate. Savings interest rate is very less. You deposit in the bank will give you low interest rate. They will give you only 5.5. Fixed deposit you are supposed to get before the month of January 2020. January 2020 the interest rate was 9.5, 9.6. Now what's interest rate? 5.5. 5.5 in a 1 year if you give a fixed deposit. Okay, so interest rate is low. And how this interest rate is, what is the relationship between interest rate and the inflation? Why this changes in interest rate? When there is more, increase in price of goods, so automatically what will happen? The purchasing power of the people will come down. To enhance the purchasing power of the people, they reduce what? The interest rate. How they reduce interest rate? What will be the effect on economy? How the RBI will reduce interest rate? There are two things. What is that? Repo rate and what? Reverse repo rate. Repo rate and reverse repo rate. So what is the repo rate? The rate at which RBI lends money to what? Commercial banks. The reverse repo rate means what? The rate at which commercial banks lend money to what? RBI. So once the RBI reduces the repo rate, what will happen? For example, a bank, Punjab National Bank is going and borrowing from RBI, say for example 500 crore, they are borrowing from RBI. Okay? So now the earlier the interest rate was 5%, now reduced to 4.1. What will happen? Punjab National Bank will borrow more, will borrow less? They borrow more because interest rate is less. They borrow more. So when they borrow more, what happens? The borrowings of banks increase. So what will they keep this money in their bank? So they lend. So when they borrow more, what will happen? The loans increase. We start buying more loans. We start going for more loans. Retail lending increases. When the interest rate of repo decreases, what will happen? The retail lending rate decreases. Housing loan, vehicle loan, gold loan, all these lending rate decreases. What happens? People borrow more. When we borrow more, what happens? Our purchasing power increases. So when our purchasing power increases, what happens? We buy more. Demand increases. When demand increases, what happens? The price starts increasing. Okay, so to reduce the price, again what happens? They enhance the interest rate. So it's a trade-off. It's always a trade-off. Now the demand is low. So when the demand is low, they reduce the interest rate. So consequently, what happens? The demand or the price, the demand increases, then price starts increasing. The price starts increasing, then what happens? Automatically again the RBI increase the repo rate. So when I am saying, I have told the entire cycle within 2 minutes, but the cycle takes minimum 9 months to to come to the real economy. So I am saying one bank is going and borrowing and then they lend money. So this cycle takes what? Minimum 3 quarters to come a real effect in the economy. To come to a real economy in the effect, it takes a minimum 3 quarters. Okay, so now the interest rate is low. So slowly, demand starts increasing. To enhance the demand, the interest rates are low and demand starts increasing. At one point of time, the price starts increasing. Then what happens? Again, after 3 quarters, again the repo rate will what? Repo rate will increase. To reduce what? To reduce the price. So this is the cycle that RBI has got. So every country has got its own central bank. So this central bank controls what? This interest rate. So this interest rate risk, now the interest rate is low. So the automobile loan, will it increase or decrease? Automobile loan, it will increase. People start more borrowing. They start borrowing more because to buy more automobiles. Okay, so automobile loan will increase. Gold loan rate will increase. Okay, so what happens is so this particular control over interest rate, every company is subject to. So the moment the repo rate falls, what will be the effect on that particular day stock on Tata Motors, Mahindra and Mahindra, all these bank stocks? What will happen? The interest, what will happen? That will be a change. There will be a change in these stock prices. Either it increase or decrease, depends on sentiment of the investors. Okay, so there is the companies are doing well. Whether it is Tata Motors or Mahindra or bank stocks, they are doing well. By fundamentally they are doing well. But on a particular day, there will be a change in the stock due to what? Announcement by RBI. So this is subject to what? Every company in the industry. So this is particular announcement, the company doesn't have any control. The company as such doesn't have any control over this kind of announcement, this kind of change the company's stock. So that is called what? Interest rate risk. Changes in interest rate, either decrease in interest rate or increase in interest rate. By what? RBI. Consequently, there is an effect on what? Economy. Then, second one is what? Market risk. So market risk is part of systematic risk. Okay? So in the mutual fund document, they don't say systematic risk. Mutual fund document, they don't say systematic risk. They should have said, technically speaking, they should say what? Systematic risk. But systematic risk means so technical. So people don't understand. That's why they use one of the components of what? Systematic risk. In the market mutual fund document, your investment is subject to what? Market risk. What risk they refer to? This particular risk, which is one of the components of what? Systematic risk. So what is this? As we have discussed earlier, bull-bear factors. Bullish and bearish trend. So this bullish trend, stocks are what? Advancing. Stocks are increasing, advancing. Bearish trend, stocks are what? Falling. Stocks are what? Decreasing. So this bull-bear factors depends on what? The bull-bear factors depends on what? Depends on demand and supply of a stock on a particular time, on a particular minute. We have seen that, how the stock market behaves. Okay? Demand and supply of stock on a particular minute. So this today for example, at this particular time, there is more supply of one particular stock, Asian Paints for example. One fellow has sold, from Delhi he has sold 100 Asian Paint stock immediately. Nobody is there to buy. Supply is less, supply is more, demand is less. So what happens? This particular company, Asian Paint stock, increase or decrease? Decrease. So is it, who is responsible? Asian Paint is responsible. Is Asian Paint responsible for this act? One investor in Asian Paint, this one, he started selling it. Asian Paint is doing extremely well. Okay, so he doesn't have any control over it. Can he call a fellow who is selling this particular stock? Can he call and tell him, hey, please don't sell my stock? Can he go and tell him? Can MD call that investor and tell him, so don't sell this stock? Can he tell him? He cannot say that. So company doesn't have any control over this. So demand and supply of a particular company stock at a particular moment. So that decide what? Market is. That is what? Bull and what? Bull and bear factors. That who decides? The investor sentiments. Depends on that particular day investor sentiments. Okay, as I was telling, I have Punjab National Bank stock. I mean, I bought it very long back. So I have a very huge loss I had now. Very huge loss I have. My broker has been calling me and telling me, sir, you sell that stock. I am keeping it hold because the bank is doing extremely well. So I know that the stock will bounce back. Surely stock will bounce back. Okay, so I bought it at 218 rupees. 218 rupees I bought along way back 7 years before I bought. So I want it for a very long term stock. Now it's trading only 28 rupees. Just imagine. Per stock I lost 200 rupees. Then he said, so I know that this Punjab National Bank is second largest bank in the country. Okay, so all this consolidation, this stock is not performing well. Fundamentally the stock is extremely good. So I am keeping it hold. Okay, so the moment like this, the brokers will send a sentiment. Brokers will call because I know the background. I am not selling it. Will every investor will stay back like this? No. So the moment broker is calling and telling them, then what? They sell it. So that will happen. That particular day, the stock price will what? Go down. Okay. So the company cannot have any control over this what? Investor sentiments. So in this point, I want to make one concept called insider trading. Insider trading. Anybody? Have you heard about this word?
Yes.
What is that? Yes.
So, people within the organization may tell the information to outsiders to write the stocks, like some information very important. For example, Prestige was coming up with a project, and the people who were there, they tell their relatives and everybody to buy those shares.
Good. Very good. Excellent. C-section, no?
Yes,
C-section, who is there? Because is there? Because who is there? You already got a marks already. How many marks you got already? 3 marks already got. Okay. Because is there? He's not absent. Because is there? Absent. Hello? Jivita is there? Jivita? Nobody is there. Jivita? Jivita is there? Jivita is a class representative. Jivita is absent. Jivita absent. Then who is taking attendance? Hello? You are taking. You are C-section, huh?
Yes, sir.
Okay. Just to inform. What is it? Because. Inform because to give our friend. Shoaib. Shoaib.
The because is there, sir.
Because is there. What's the receipt number? Hello. Now you are talking about network issue. You can never talk about network issue, my dear. Audible. So what is your receipt number?
196.
196. 196. 196. Give him 2 marks. Okay. So you got 5 marks now. 196. 5 marks. Okay. So what happens is a company person, a key official, key company official, he knows the secret, very secret information. So that secret information is leaking out, and by which he capitalized the gain. Okay. So I mean, now and then what happens is there is surveillance. SEBI surveillance is there. SEBI surveillance. Surveillance means they catch this kind of, the insider trading is unlawful. It's not a legal activity. It's an unlawful activity. Okay, so a criminal case is there against it. Because if you have a very secret information, you are not supposed to leak out. Because thereby, you buy this particular stock, on the particular day, the announcement is made, the stock price will increase, you sell that particular stock. So, if you want to make a very speculative gain, very quick profit, you know this announcement will come following week. So what happens is, today itself we start buying this particular stock. So on a particular day, the following week, the announcement has been made, stock price will increase, you sell this stock. Make an extraordinary gain. It's called insider trading. Okay? So, this is very unlawful activity. Last week, so now and then SEBI has got a very high surveillance. So this particular cell, surveillance cell, will look at one particular stock is traded unnecessarily. Many people are buying this particular stock. In such case, the SEBI will make a thorough investigation. If it is found true, that particular official, whoever is bought, that particular official will be fined or will be sent to a jail. So 2 weeks before, an important person, a big official in Infosys, he has to pay 14 crore fine. 14 crore he has to pay fine. That means what? He would have made more than 100 crore profit in the stock market. Okay? And Z Entertainment, recently, Z Entertainment, a company, you can put in the Google, you can put in Google now, okay? Z Entertainment has been booked for insider trading. Has been booked for insider trading recently. You can see in the net now. If you put Z Entertainment, immediately this particular news only it will come, because the company is in deep trouble now because of this insider trading. Some fellows, Z Entertainment shares. See, look at that. 182, it's trading at 182. Z Entertainment, insider trading. Okay. So who found this? Who is responsible for finding all this? SEBI. See, look at that. See here, interim order in the matter of insider trading shares of SEBI is given here last week, August 12th. Interim order has been issued by SEBI for insider trading. Huge amount of money has been made from this Z Entertainment. Because some important information they know, they cornered the shares, they bought the shares, and they have been caught. Okay, so like this. So when it happens, some particular company shares, by use of this insider trading, that particular company stock price will increase all of a sudden. Okay, so that will lead to what? That will lead to what? Bullish. That will lead to bullish market on a particular stock. And then what happens is, on a date of announcement, these people start selling these particular stocks. Okay, so insider trading also makes the market risk. So one of the reasons for what? Market risk. Okay, so market risk is uncontrollable factor. Okay, and third one is what? Purchasing power risk. Purchasing power risk. Purchasing power risk? Yeah. Yeah.
So can insider trading be considered the other way around? So for example, if a negative news is going to be coming up, and if someone already holds the shares of that company, can he tell out?
No, whether it is positive or negative, the moment you know about a particular company vital information, these vital information can be positive or negative. This vital information should not be shared. So that is your self-accountability. How do you come to know this information? Because you are part of the company. Either a company director or company CEO or company chartered accountant. So these are all the people will come to know this information first. Correct? So, it's like a government, before the government started investing in a particular place, okay? So, I mean, people who are making this particular plan, they will come to know first. They started buying this land nearby. You got a point? One big project is coming on a particular place. So, the people who are planning will come to know earlier. Okay? So, the project will come when after 10 years or after 15 years. But plan is made now. So, what happens is, people who are making this plan, they will come to know. They start buying the neighboring land. So that the project comes, the land price will shoot up. The same concept here. Okay? So you know that vital information. So this vital information you are not supposed to share. So it's an unlawful activity. Okay? So very high surveillance we have with the SEBI. All have been caught. And it will come in the newspaper. The name itself it is coming in Infosys. He's a very big director. His name has come. For them, it's a big news. It's not a big problem because you make a lot of money, and then what is that? You have your own strong legal advocates. You have pay and then you come out. You will be very cool-minded as we have our son of soil in London. He is very cool. Right? Who is that? He is very cool. Not care. So you have very strong person, doesn't care about it. Okay? So insider trading is one of the factors of market risk. Purchasing power risk is related with what? Interest rate risk. Purchasing power is related with what? Interest rate risk. Purchasing power risk, the interest rate is low. What happens? Purchasing power increases. Purchasing power increases, then demand of the commodity increases, so we buy more. The interest rate is high, what happens? The purchasing power is less, the demand is less. Okay? So to trade off demand and supply, the interest rate is used for making the balance of what? The demand and supply. So purchasing power risk is also part of what? Systematic risk. Okay? So the three types of systematic risk. So what are the main factors? Main factors are a war calamity. Government doesn't have any control over it. Now Afghanistan, we don't know what happens tomorrow. Okay? So a lot of issues are going to come. Okay? So this kind of uncertainty. Then best example, COVID-19. Nobody is expected to that extent. Okay? So all of us thought with that lockdown last year, it will go away. Still it is persisting. It will be there with us. So this kind of pandemic which is coming, no company can have any control over it. Okay? And then international oil prices. International oil prices. Price is falling now. Now it's what's the price now? International oil price. Management student, we should know all this in fingertips. What is international price now? Oil price. How our neighboring state reduced 3 rupees in his budget, petrol price. Neighboring state, no? So everybody is going to what? Hosur side to fill the petrol. Where they want the price has come down. 3 rupees has come down, correct? The neighboring state. So everybody will go where? To Hosur to fill the tank. Their money is less, petrol is less. Why one particular government can give, another government cannot give? What is the price? International oil price? 68 rupees per barrel. 68. It was 84 and it has come down to 64. Now it's trading low, but our price has not fallen. When international oil price has fallen, our retail price also should fall, correct? So from July 17, the price is not touched. Price is untouched. From July 17. July 17 was the last revised price. All of you are tracking it now. All this should be tracked. Okay? So past 1 month it is untouched. Though the price is falling. Though the international price is falling, our price is what? Untouched. Because we pay as I was mentioning earlier, we pay how much percentage as a tax? 98% of tax. 98% tax on the oil, on petrol and diesel. 98%. Both state as well as central tax. 98%. That's why we have been deliberating this oil price, both petrol and diesel, under what? GST. GST, what is the highest rate? 28%. If you pay 28% at the highest GST rate, we buy petrol and diesel at the rate of what? 54 rupees. 52 rupees. Okay? So, where is 28%? Where is 98%? Where is 28%? Where is 98%? Okay? So, when the government gives subsidy, government is announcing subsidy, 6,000 crore, 9,000 crore, subsidy has been announced. From where the government can give? Government also should have a revenue, no? Should have money, and only can give subsidy. A subsidy for, farm loan, subsidy for agriculture loan, power loan, all this waived off. How they can waive off? It's all political agenda, election agenda, to reduce all this tax, reduce all this, to subsidy. Subsidy comes from where? From this money. So one way you get it, tax, and pay what? Subsidy for your election manifesto. So no government can reduce what? Below this particular rate. Otherwise, the subsidy should be what? Reduced. Without subsidy, our election manifesto cannot run. So we have to announce a big election manifesto, and only party will win. So all this, it's a give and take policy. One way you give, one way you take, another way you give. So no government can make it this particular price to the extent of what? GST. All political parties have been talking about bring it to the GST rate. We are paying 98% the tax rate. No government can reduce it unless you reduce what? Subsidies. Because we cannot reduce subsidies. When we reduce subsidies, what happens is, because people in our country live more than 60% rural areas, then without subsidy, how do you live it? So you have to maintain both. So you will have to go ahead with that. Okay? So international change in international oil price. So international oil price affect what? The market. So these are all the factors which affect what? Systematic risk. Okay? War, calamity, pandemic, change in international oil price. Okay? So these are all what affect what? The factors of what? Systematic risk. The second component is what? Unsystematic risk. Controllable risk. Diversifiable risk. Unsystematic risk, controllable risk, diversifiable risk, which is related to a particular company, particular industry. This is common to everybody. Systematic risk is what? Common to everybody. Okay, whether you are a big company or a small company, every company is subject to. That means the moment we start a business, any business activity, you start with what? You start with what? Systematic risk. You start any business activity, you start with what? You start with systematic risk. That's why always we say business means risk. What risk that we refer to? Systematic risk. Okay? So unsystematic risk is opposite, related to a particular company, particular industry. So it is also known as what? Non-diversifiable risk. It is also known as what? Controllable risk. Okay? There are two factors, two risks here. One is business risk. Another one is what? Financial risk. Business risk and financial risk. Business risk and financial risk. Business risk refers to what? The fundamentals of a business. Lack of quality raw materials, lack of quality human resource, turnover, labor turnover, human resource turnover, retention, human retention, lack of training, lack of quality missions. Okay? So these are all subject to what? Labor strike, death of a key financial officer, key officer in a company, the death of a big officer in a company. These are all attribute to what? A particular company. These are related to what? A particular business. Okay? Lack of low quality materials, low quality missions, lack of quality human resource, lack of training facilities. Okay, all these are all what? A business which affects what? The fundamentals of a company. So this, the company should control over it. The company should reduce these risk factors by making proper strategies. By making proper plan, by making proper strategies, company should reduce these risk factors, business risk factors. Then we have financial risk. Financial risks, I think about what? Leverage. Leverage. What is that? What is called leverage? What's called leverage? Use of debt. Use of debt in your capital structure. Use of debt in your capital structure. Sir, why are you giving more importance of use of debt in your capital structure? Capital means what? Without capital, no business can run, correct? Correct, no? There are, as we have discussed earlier, there are two ways we can raise funds in capital. One is what? Debt funds. Another one is what? Equity funds. What is equity funds? Own funds. One fund is called equity funds. So debt funds or equity funds. Okay? So debt funds, what is the nature of debt funds? What is the nature of debt funds? You will have to pay what? Interest. Whether you run at a loss or profit, you have to pay what? Interest. Okay? So what happens is what? The interest becomes what? So in your operating profit, how do you get operating profit? It's called operating profit is also called what? EBIT. How do you get that? How do you get that? Revenue? Revenue or sales? Sales minus what? All your expense overheads. Expense related direct expenses. It's called overheads. Okay? Or we call it as a cost of goods sold in accounting term. In accounting term we call them as what? Cost of goods sold. You get what? Your gross profit. Your gross profit, cost of goods sold. Then you have what? All your overheads, administrative overheads, selling and administration, selling and distribution overheads. Okay? You get what? The remaining, that's what we call the operating expenses. Operating expenses. You get what? EBIT. All the startups, including Zomato, make this is what? Loss. All the companies are making loss. This particular point is minus here. All these startups. Revenue is there. They have revenue. Revenue increases. But all are reporting loss. So, due to the, startup policy of our country, even though the company is making a loss, the companies are what? Companies are allowed to go for what? IPOs. Companies are permitted to go for IPOs. We have seen all that. Okay? So they are making loss here. From this, you have to pay what? This is minus. This is minus. Okay? Interest you have to pay. Interest you have to pay. How do you pay interest? You have a loss. How do you pay interest? If you have profit, you collect the interest. Here you have say 1 crore you have to pay. How do you pay? You have a loss there. How do you pay? Huh? How do you pay? Huh? Borrow more. You borrow more. No other way. Borrow more. Or some other investor is ready with your fund. You sell your stake, equity stake. This is what the company does. Still Byju's making loss. For your information. Byju's big sponsor now of all the cricket match. No? All the cricket match big sponsor here, and they bought 18-year-old that Agash they bought. But is the company reporting profit? No. Company is not reporting profit. Company is reporting what? Losses. Still reporting losses. Okay. So again they bought. So here, this is what we talk about leverage. Here, this is what we call operating leverage. So your operating leverage is high or operating leverage is low? Operating leverage is what? Very high. Why? You are reporting what? Operating loss. Okay, so the company operates what? So here the company has to pay interest though the company reports operating loss. So interest payment is mandatory on the part of a company. Same way the principal repayment is mandatory on the part of a company. After you are borrowing for say 7 years, you have to pay back the principal amount after 7 years. Okay, so this is the risk the company is having. So that risk is called what? Operating leverage. That's what we call leverage. So the financial risk is what? The use of debt in the capital. The higher use of debt, the company is operating on very high leverage. High levered company. High levered company means what? The company which is operating more on debt. That means the company has to be more careful. Highly careful. Okay? So the company, that's what we talked about, two business models. There are two business models we have in the entire world. One is what? You sell your service, you sell your products on what? In cash. You sell your service, you sell your product in cash. You borrow all your raw materials. You take your service on what? Credit. That means you can operate on more on debt. Why? You sell your product in cash. Example, retail business. You take any retail. What we have? Metro retail. You have metro retail, you know. No? Can you go and buy for 200 rupees? Minimum bill is how much? Minimum bill is how much? 1,000. When you go to metro, I'm not talking about metro train. I'm talking about metro retail business. Minimum 1,000 rupees bill. Okay? Then only you can go and buy. You know? DMart is organized, very high organized retail. Okay? So after taking all your products, when you come to the shop, can you say, can I pay later? Can you say? So they operate on which business model? They sell their products in cash. How do they buy? They buy from Hindustan Unilever, they buy from ITC, they buy from Britannia. Okay, all these companies are supplying all your finished products. Are they paying you money in advance? They get what? Minimum 2 months advance, 2 months credit period, minimum 2 months credit period. So you operate on what? Credit. So what happens? So such kind of business models can employ more debt. So you can go up to the maximum of how much? 70%. 70% you can employ debt, 30% can be equity. So manufacturing companies cannot have more debt because they operate on what? Credit. They operate on credit. Why? Credit is one of the promotional tools. So as we have promotional tools, advertisement, sales promotion, these are all what? One of the promotions, one of the tools of what? Enhancing your sales. Okay? So credit is one of the tools of what? Enhancing sales. In case of manufacturing. Because wasted the natural resource. Oh, no. Okay, no. She's so involved in listening, so she forgot. Okay. Good. So, such companies, manufacturing companies, cannot employ more debt because they employ on what? They employ more debt. So, what would be the capital structure? The capital structure would be 70-30, ulta. That means what? They have to use 70% equity funds, 30% what? 30% debt funds. So we'll have 5 minutes break, we'll come back here. Thank you. Okay, 10 minutes. See, this part of it. So elements of risk. Okay, all this we have seen. systematic risk and systematic risk, non-reversible factors. Now we need to see the measurement of risk. Okay, so next is what? Next our discussion is measurement of risk. So we'll have to measure the total risk. We'll have to measure the total risk. We'll have to compute total risk. We'll have to compute systematic risk. We cannot compute unsystematic risk because it is subject to a company. Each company will have a different systematic and unsystematic risk factors. Okay, so when we take up one company, then we'll have to study. So we'll have to measure total risk and systematic risks. So next discussion is how we calculate total risk, how we calculate systematic risk. Now first one, computation of total risk. Computation of total risk. So total risk can be computed through a statistical measure called standard deviation. Through a statistical measure called standard deviation. Why standard deviation? So standard deviation, what does it do? Standard deviation, how is it? What is called standard deviation? What's the meaning of standard deviation? What does it do? What does it calculate?
The rate of deviation.
The rate of deviation from what? Central tendencies. So we have a mean return. How each return is deviating from a central level, central theme. That is called standard deviation. Okay. So first we need to calculate. So the square root of deviation from mean. Square root of deviation from mean is called what? Standard deviation. So first we need to calculate the mean return. Then compute what? The deviation from mean return. Okay, square it so that the minus will be removed, and then what? Take the sum the square of the deviation and take the square root, which will give you what? Standard deviation. Without square root, it is called what? Variance. So variance of returns. Why the standard deviation is used? Because that calculates how each return is varying from a mean return. Higher the variance, higher the risk. Lower the variance, lower the risk. So variance is the measure which is used for computing total risk. The square root of variance is called what? Standard deviation. Square root of variance is called standard deviation. So let us look at the example. Okay, this is the equation. Let us look at the example now. So let us calculate. Let's calculate. We have 5-year return. 5-year return. 1, 2, 3, 4, 5. 5-year return. Okay. So what's the return? Ri. Ri is what? Yeah, come. 10, 30, minus 20, 0, and what? 10. 20, sorry, 20. So first you have to calculate what? First you have to calculate sigma R. First you will calculate sigma Ra. What is sigma Ra? 40. 40. Sigma Ra is 40. Okay. Now calculate R bar I. What is R bar I? 40 by sigma Ri by n. So how much? 8%. Got it? What have you understood? First you calculate sigma, get the average. Now we are calculating what? How it is varying from? How is deviating from what? Mean. How is deviating from mean? So how to calculate? Ri minus what? R bar I. Ri minus R bar I. Ra minus R bar I. How to calculate? 10 minus 2. 30 minus 8, 22. Minus 20, minus 8, minus 28, minus 8, 12. Correct? Have you got it? Is it clear? All of you understood? Is that clear? Now we need to what? Square root. We take the square root. Why we take the square root? To remove the minus symbol. Is that Ri minus R bar I whole square. Whole square. How much? 4. 4. Then how much? 2. 490. 484. It will be 28. 784. 64. 140. 144. Okay? Compute sigma Ri minus R bar I whole square. Sigma Ri minus R bar I whole square. How much comes? 1,480. 1,480. Okay? So what is the standard deviation square? What is called standard deviation square? Standard deviation square is called what? Variance. Standard deviation square is also called what? Variance. Variance. Standard deviation square or variance. Okay? So how to calculate? Sigma Ri minus R bar I whole square divide by n minus 1. Divide by n minus 1. That's the equation. N minus 1. Okay? N minus 1. That is 1,480 divided by what? 4. 370. So what is standard deviation? Root of what? 370. Root of 370. 19.24 percentage. Is it clear? Calculation. Calculation, is it clear? What do you do? First you calculate what? Sigma R. Okay. Ri. Then you calculate what? Variance. Variation you calculate. It's called variation. You calculate. Then what? Square root. Take the square root. Sum it up. Divide by what? N minus 1. Take the square root. To take the square root of deviations, you will have standard deviations. Now, what does it mean? The standard deviation of the return is 19.24. Standard deviation of return is 19.24. What does it mean? Does it give any meaning? See, management is for what? For taking decisions. We are here for what? Taking decisions. If you put it in Excel, which will give you within a fraction of a second. You put it in Excel, all this, complete return. Here only 5 companies, Excel will give you what? 500 companies, if you put it, Excel will give you within what? Within a minute, Excel will give you the figure. Okay? There are only 5 companies we are taking it for our calculation. When you take up a project, for your project next semester, you are doing it for what? 70 companies, 100 companies, you have to do it. Same calculation. Calculation will remain same. Okay? You drag it, you get the return, all the return. How do you get this return? How do you get this return? No, here return is given for your examination point of view. I am talking about your reality. project point of view, when you are using it, how do you get that? You have a closing price. You have a closing price. And you have what? Today beginning price. You have a closing price and today beginning price. So how do you get the return? Closing price minus beginning price divided by beginning price. Closing price minus beginning price divided by beginning price. Don't multiply with 100. Okay? Because when you drag it, it will be the percentage. So you should have a decimal. So closing price minus beginning price divided by beginning price. So where do you get all these prices? Moneycontrol.com. NSE we used to get, but NSE now today is a paid data. And so you have to pay for the money. Because data you have to pay money. So moneycontrol.com you can download all these company stocks. Okay? So closing price minus beginning price divided by beginning price, which will give you that particular day return. Okay? So I mean you have to if you want to calculate for 1 year. So 1 year in a month you will have how many days price you have in a month? In a week how many days? 5 days. 5 days. Monday to Friday. Saturday, Sunday market is closed. Okay, so Monday to Friday. Then you have, if it is in 5 weeks, if it is 5 weeks you will have what? 20 prices. 20 prices you will have. Maximum you will have 22. 22 price you will have in a month. Okay, so for 1 year, 22 into 12. So maximum you have 240. 240 to 245 price you will have for 1 year. Okay, so you have to go for 5 years. Project means you have to go for 5 years. So 5 years return in Excel sheet. Okay, so you have to put all this return, you have to put in the cell, put the formula, equal sign formula, you will get the values. Okay, now the question is, Excel will give you within a fraction of second 19.24. What does it mean? You say the risk of and the risk standard deviation of return is 19.24. From this, what decision we make? Standard deviation is an absolute measure. Standard deviation is an absolute measure. What does it mean? It doesn't give us anything to take decision. It is not a relative measure. It is an absolute measure. So we can say the standard deviation of a stock return is 19.24. It provides a meaningful information only when it is compared with another stock. So you have stock A 19.24, stock B 25.24. That means, which gives you what? A meaningful information. What does it mean? Stock B return risk is higher than what? Stock A. Okay, so it is not a relative measure. It is an absolute measure. So that is the important drawback of using standard deviation. You got it? So you will have to compare with another company's stock. The another company's stock return risk is higher, then you can say stock B is higher risk than stock A. That means what? Stock B should provide what? Higher return. The average return here is 8. Stock B should have been more than 8. Why? The risk is higher. The stock B return is 12%. Then the assumption is, the theoretical framework is right. What is the theoretical assumption? Our theoretical assumption is what? The risk is higher, the return is higher. That's what the theoretical assumption. So that theoretical assumption, you are testing it by using what? These data. So dear students, in our management, is it a science or arts? It's both. It's both arts as well as what? Science. So in a physical science or life science, students go to the lab and they test what they study in the classroom. You have a theory class and you go to the lab for testing. Whatever the assumption that you are studying, you are going for testing, whether it is right or wrong. The same thing here. You are studying here and then you are applying what you are studying in your what? In your project. This is what you are relating. This is what you are testing your assumption. So what is the theoretical assumption? Theoretical assumption is what? Higher the return, higher the risk. So the stock B should have given what? More return. If the risk is what? Higher. Okay? Did you understand? So management is what? Both science as well as what? Arts. So you are going for testing it. What you are studying now. So clear? Calculation, all of you clear? Anybody who has got any doubt for calculation? Now we have a next one. Another measure we call it the what? Coefficient of variation. Coefficient of variation. Coefficient of variation shows the relationship between standard deviation and mean. CV, coefficient of variation. Relationship between standard deviation and mean. Okay? So higher the variation, higher the coefficient of variation, the less consistent it is. Less consistent it is. So you have the test score of Kohli and test score of Dravid. Dravid is a very big test batsman. He is not a one-day batsman, he is a test batsman. Okay? So who is consistent? Dravid is consistent in test match or Kohli is consistent test match. You are going to do it. You are going to test it. So what do you want? You want Dravid past 50 innings score, and you want what? Kohli's past 50 innings score. 50 innings. I am not talking about test and innings. So each test has got 2 innings. Okay? So 50 innings. So you calculate what? Their average score, Kohli score and Dravid score, 50 innings score. Calculate what? Standard deviation. Standard deviation of the 50 innings, Kohli score and Dravid score, and calculate what? CV, coefficient of variation. So coefficient of variation is CV is equal to standard deviation divided by R bar I into 100. Standard deviation divided by R bar I into 100. So R bar I is what? Standard deviation is what? 19.24 divided by what? 8 into 100. So what is coefficient of variation? 19.24 divided by 8 into 100. Both are percentage, no? Both are percentage. This is also percentage, this is also percentage. You don't multiply with percentage. Otherwise, what you do is 0.1924 divided by 0.08 into 100. Then 2.4. Don't multiply by 100. Why don't multiply by 100? Both are percentage. Okay? So make it decimal. 0.1924. 8% is what? 0.08 into 100. 2.4. Coefficient of variation. Okay? So calculate coefficient of variation of Kohli score, 50 innings score and Dravid score, and the CV is less, the Dravid CV is less. That means what? He is consistent. He is consistent in test match. The CV is high, he is not consistent. That means what? One innings he will score 100, another innings he will be done. So he has to be consistent. Test match means what? Consistency is very important. Not you are making 300 in one test match and another 5 matches if you have done. That is not consistent. Understand? Is it clear? So this is how what we study, you are applying in what we are studying. So whatever we study, we need to apply. When we apply only, it is called what? Science. Then only we create what? Skill. The application enhances what? Your skills. That means you will never forget. See, why we are forgetting what we are learning? Because we are studying for what? Examination. That we should stop. The moment you study for examination, you will never keep in your mind, you will forget. My question is, you have learned car driving 10 years before. Okay? But you are an excellent driver. You drove 1 lakh kilometers. Now people say, the moment car driving, if you drive for 10,000 kilometers, you are somewhat skillful. 10,000 kilometers you should drive. Then only you are what? A moderate, skillful driver. Okay? You drove for 1 lakh kilometers, then you will drive for next 10 years. 11th year you start driving. Will you forget the driving? Huh? Will you forget the driving? Why? So 10 years you didn't drive. You will forget. Why? Because you learned what? Skill. You learned that skill. You will never forget. Okay? That's what I am trying to say. So whatever you are learning, you apply it, whatever you are studying, then you will never forget in your life. So you are studying for the examination point of view, you are focused only for examination. That means whatever you study, the moment your examination is over, you will forget. Please understand that. So management is not for examination. Management is for what? Application. What you apply in what you study. Okay? So what you are going to now you will have to calculate 2 company stocks. 2 company stocks, and you have to compare both a company stock. So CV determines the consistency of a particular return. Whether stock is consistent in providing return. Okay? So higher the consistency, is it good or bad? Higher the consistency, lower the variability. Higher the consistency, lower the variability. Lower the consistency, higher the variability. So higher the consistency, lower the variability, low risk. Lower the consistency, higher the variability, higher risk. Is that clear? So CV should be compared with another company stock. So what you have seen? You have seen standard deviation and coefficient of variation. This is the actual return. This is the actual return. Sometimes we'll have to extrapolate for expected return. Sir, why are you unnecessarily talking? Already you have an actual return only. Then why you are talking about expected return, all that? See, in your project, this is what important. For in reality, in practical application, this is important. Okay? Sometimes you will have to forecast. In a investor point of view, you will have to forecast. Sir, next year, how much I may get? Sometimes you will see, people will come with, people have got money. People have got plenty of money now. No, we don't say, the pandemic has evaded the entire liquidity. Liquidity is very high. Otherwise, our country will not see this IPO rain. IPO's raining is happening. I have told you, for past last week itself, 4 IPOs have come. 4 IPOs have come and they have raised about 40,000 crore only last week. That means what? Liquidity is now, domestic institutional investors are increasing more, not foreign investment. DII only. DII is what? Domestic institutional investors. Okay? So liquidity is very high. It doesn't mean that it has got, liquidity is completely gone away. That's why they kept the interest rate low to enhance the liquidity. Okay? So, in such case, you will have to forecast the return. For example, boom condition means what will be the return? If it is a bearish condition, the recession, what will be the return? And if it is a normal, what will be the return? So, in such scenario, how do we calculate the mean return and standard deviation return? So, please put a heading: measurement of risk. Measurement of risk. Measurement of risk hyphen expected return. The previous one is what? Previous one is what? Actual return. Actual return. This is what? Expected return. Okay? So, expected return means what? It is your assumption. Please understand. It's not actual. It's your own assumption. Okay? So as we know, there are three business conditions we have. There are three business conditions. One is what? One is storm. Storm means what? Storm means what? Boom. Boom period. Storm means boom period. Okay? So boom period, you are saying probability is 20%. 20% will be there, the boom period. How much return you are expecting? 40%. More return you are expecting. And you are little more conservative. You are little more conservative. You are saying 50% will be normal condition. It means you are more conservative. You are not either pessimistic or optimistic. Okay? And now, so you are saying average is 50%. 50. How much return? The return will be higher than boom period or less than boom period? Less than boom period. So 12%. Then always you have what? When you forecast boom and normal, always you will have what? Recession. It is applicable for business life or individual life. Even for individual, when you are there, always your growth curve will not go up. You will have what? You will have a down in your life. Okay, so how you are successful in the down trend, it is more important. Okay, so I mean Kishore Biyani is the best example. He is known as what? Retail king. He was known as retail king. Now what is the situation now? He is nowhere. Okay, so he only changed the entire retail world. So he has only brought the retail experience by starting so many big bazaars in the country. Okay, so when you have a up, there will be a down always. Okay? Then you have a weak is 30%. It's a recession. The return you cannot expect more. You are expecting what? Minus 20%. Minus 20. So in that scenario, how do we calculate mean return? How do we calculate standard deviation return? Okay? There are three situations. Boom, normal, recession. Okay? So 0.2, 0.5, 0.3 is a probability. Pi probability. The sigma probability I will be 1 always. Sigma Pi is always 1. Sigma Pi will be always 1. You cannot go beyond 100%. Okay? Clear now? Then you have Ri. Ri is what? You want to keep a decimal or you want to keep a percentage? So we'll keep. Okay? 40, 12, minus 1. Clear? Now, a slight change there. Please listen. The actual return, what we did? Actual return, we have added the total return, divided by what? N, to get the sigma Ri. Okay? Since here we have probability, multiply probability with the return. Okay? So, Ri into Pi. Ri into Pi. The previous one, what we did? You added the return, divide by what? N. N is what? 3. Here we cannot put 3 here because the probability. It's a number of years. Okay? So multiply with what? Probability and Ri. How much? 40 into 0.2. Huh? 8. Yeah, 8. 12 into 0.5. 6. Right? 6. Minus 20 into minus 6. Now listen, please listen. Sigma Pi Ri. Sigma Pi Ri. How much? 8. Please listen. The sigma Pi Ri itself is called R bar. Mode of dividing it by what? 3. This itself indicates what? R bar. There is no division called number of time is 3 because here it's not a year actually. It's a condition. It's a business condition. Business condition can be boom, business condition can be normal. So this is not a number. It's a condition. So there is no n. There is no n here. So the sum of the aggregate of PI itself is called what? R bar. Is that clear? Are all of it clear? Okay. Now the same. We go back. Standard deviation. What is that? RA minus what? R bar I. RA minus R bar I. How much? 40. 40 minus 8. 32. 12 minus 8. 4. Minus 28. Correct? Correct, no? Is it clear? Now what do you do? Square root. Ri minus R bar I, what? Whole square. Whole square. Okay? Much? 32 into 32, 1000? 1024. 16? 780? Now, the previous case, what we did? The previous case, what we did? You have sum it up and divide by what? N minus 1. The previous case, actual written case. But here, you have to multiply this with Pi. Pi into Ri minus R bar I whole square. Okay. Pi into Ra minus R bar I whole square. We have to multiply the square with what? The probability. It is 0.2 into what? 1024. How much? 204.8. 16 into 0.5. 8. 784 into 0.3. 235.2. Okay? Sigma Pi Ra minus R bar I whole square. 448. Please listen. Earlier you have put n minus 1. Okay? Same way here. R bar I. Same way here. This itself is called standard deviation square. So standard deviation square is called what? 448. Same thing. You need not divide it by n. Standard deviation square. Okay? So what is standard deviation? Root of 21 point? 21.2. Okay. I repeat. Here the situation is depends on different economic condition how the return will change. Expected return. It's not actual return, expected return. Okay. So in reality we don't use all these economic conditions. Sometimes if you are able to forecast, these are all your own assumptions. This will be your probability. This will be your return. Okay? Because when the investor comes for different perspective, you will have to say, this is all your own assumption. Okay, with a given condition. So we will have to be a little more conservative here. We should not be either optimistic or should be pessimistic. That is why the conservative sum is used here. That means you are saying 50% will be what? A normal condition. 30% will be what you are, you are saying a recession, boom period. Then 20% will be what? A recession period. So when you expect your return, your recession return will be relatively low, should be keep it very low, okay, and your boom period return will be relatively higher. Normal you should keep a moderate return, okay. So in that scenario, how to calculate mean return and standard deviation? Procedure is same. First you have to calculate is what? You multiply Pi with Ri. Multiply Pi with Ri, okay. The sum of Pi Ri itself is called what? R bar I. Node of dividing it by n, because here we don't have a n, we have only what? Economic conditions. So we cannot divide it by n. Okay? So that aggregate itself is called what? R bar. Then the next two procedure is same. Ri minus R bar I, Ri minus R bar I whole square. Okay? Since here we are given probability, multiply with the probability and sum it up. So that itself is called what? Variance. It's called variance. Square root of variance is called what? Standard deviation. Online class, all of you understood? Hello? Online. All of you understood? Is that clear? Is that clear? Okay. So we'll take up, all these are there in your LMS. Some more few cases are there in the LMS. Kindly, I am taking one more case for little more of understanding. Yeah, this risk return case is there. The LMS itself is all these cases are there. You can just practice it. We will take one more case. We will take. Do you want me to take actual return or expected return? Which one you want me to take? Expected return. We'll take. Expected return we'll take. I'll share the screen. I'll share the screen. Okay. Have you seen that? So all these cases are there. Yeah, it's here. How many cases are there? You can just, with the answers it is given. LMS with answers it is given. You can go through that. Okay. Let us take this. Let us take this. What you have seen? Huh?
So you need to maximize it.
Maximize it. Is it okay? Can you see that?
No, sir.
Please note down. Offline, online, all of you can see that, correct? Online, can you see that? Yeah, please take, offline. Please note down. State of the economy, can read. State of the economy, Pi, Ri. State of the economy, Pi, Ri. State of the economy, Pi, Ri. Boom, 0.6. Boom, 0.6. Ri is 45%. Normal, 0.2. So is pessimistic or optimistic? Pessimistic or optimistic? He's optimistic. That's why he is saying what? Boom is 60%. It's highly optimistic. Okay. 0.2, 16%. Normal, 0.2, 16%. Recession, 0.2, minus 20%. Recession 0.2 minus 20%. Minus 20%. Okay. So please take. Okay. Please take that. Okay. Boom. 0.6. 0.2. 0.2. Alright. 45, 16, minus 20. So RIPA 45 into 0.6, 45 into 0.6, 20, 27, 16 into 0.2, 3.2, no? 3.2, minus 0.4. minus 0.4. So sigma pi ri. Sigma pi ri. How much?
26.2.
26.2. So what is this called? R bar I. R bar I is 26.2. Online students, all of you understood? Huh? Huh? Sorry. Online students, all of you understood? Hello? Online students, all of you understood? Okay. Now, Ri minus R bar I, that is 27 minus 26.2. Huh? 1.2. 20? Correct, no?
Yes, sir. Correct, sir.
It's 27 minus 26.2. 1.8. 3.2 minus 26.2. 23 minus 23. Correct?
Yes, sir.
Then minus 30.2. Okay. Ra minus R bar I whole square. So this 0.64. Correct? 0.64. 23 square. 530. 529, no? 529. Ah. 6.4.
45 minus 26.
Oh, sorry. Yeah, 45 minus 26. Oh, sorry. 45 minus 26.2. 18.8. Yeah, 18.8. 16 point. Yeah, correct. Ra minus R. 18 point? 0.8. 45 minus 26.2.
This one, Ri minus R bar I.
Ra minus R bar I. Yeah, that is 45 minus 18.8. 18.8. 10.2 minus 46 point. Okay, sorry.
Minus 10.
Minus 10 point. Okay, correct. So when you take the figures, you be very careful. Yeah. So 18.8 into 8 square. How much? 353.4. Then 104.04. Then 213.44. 2134.44. Okay. Then multiply with pi. 353.4 into 0.6. 0.6. 353.4 into 0.6. 220. 212.04. Then 104.04 into 0.2. 20.808.
426.
Last one. 426.8. 8. So sigma Pi Ri minus R by 659.736. Okay, this is called variance. Standard deviation square. 659.736. Standard deviation is equal to root of 659.736. 45.69. 45.69. 25. Got it? Online students, all of you understood? Is that clear? Anybody, any clarification? So what is called CV? Calculate CV. CV is equal to 25.69 divided by 26.2. 25.69 divided by 26.2. 0.9. Close to 1. Okay. So anybody was got any doubt? This computation of total risk. So we have calculated total risk for actual return and expected return. So tomorrow we will take the computation of systematic risk. Computation of systematic risk tomorrow. Okay. We will take the real-time value. So why we cannot do real-time value? Because when you take real-time value, you will get all decimals. We will take all decimals. So we require an Excel sheet. So we will take the real-time value for understanding real-time value. For our understanding, we will calculate here. Then we will take up the hypothetical figure for our understanding. Real-time figures for real-time calculation for your project-wise. So whenever we take finance projects in the portfolio, these are all the calculations that we will have to make for calculation. Okay. So any clarification, anybody, anything you want to ask? One more concept I want to finish. Anchor investors. Have you heard about this word? Anchor investors in IPO, especially for IPO. Anchor investors. What happens is before the company comes for IPO, how the market behaves, nobody knows. Anybody is there to buy the company shares. Many companies are coming now. Many companies are coming. Paytm is also coming for issuing shares, but they are in trouble now. What happens is one NRI, he settled in US, one 71-year-old man. He invested in 1993 when Paytm started. What's the Paytm company called? 197 Communication. 197 Communication. So when they started 1993, the owner is here in Bangalore. He was in Delhi, now he is in Bangalore. He is here only. So he was allotted some percentage of shares. I mean, he bought some percentage of shares because at that time when you are very young, you require fund. So what do? Whomever you are coming with the fund, you invite them for funding. So he invested some percentage of shares, and now he filed a case in the High Court. He was not given certificate share. He was not allotted shares. He was not allotted shares. So he filed a case in High Court. Now the IPO may be delayed because of this particular case. So they are investigating whether he bought a share or whether he invested here, why he is not invested. So anchor investors, when the company comes for IPO, whether the company does it well or not, we don't know. Okay? So before the company comes for IPO, some percentage will be given to some institutions. So anchor investors are institutional investors. percentage of shares have been allotted before the company comes for IPO. Once this many investors are coming forward for buying this buy these shares before IPO, that means what? The company looks very good. So you are giving a clue for a retail investors, for a market, this company looks very good. That's why many investors are coming forward to buy these investors. Okay? Once IPO is over, once a listing is done, this anchor investors creates liquidity in the market. They sell and buy. There are 10 anchor investors. So somebody has to sell, somebody has to buy in the market. Okay? So these anchor investors make buy and sell transactions. So anchor investors in post IPO makes the liquidity in the market. The pre-IPO provides the base for the price, base for the retail investors whether to buy or not. So anchor investors are usually what? Institutional investors, not the individuals, institutional investors. Okay? Anchor investors. So a term that you need to understand because it's not there in the syllabus, because we discuss so many things out of the syllabus. You need to understand all this. So another one is called grey market premium. Grey market premium, GMP. Grey market premium. It means before the company comes for IPO, illegally people buy and sell the shares in the market, which is not allowed. In that particular market, the premium is high. That means this particular company will be listed. Today, one company is getting listed. XRO, one company is getting listed. And let me find out. Okay, thank you very much. We will meet. Thank you. We'll meet tomorrow. Thank you. Please send me the attendance. Hello? Yeah, we'll send it.